Hey, Norok.
Hi, how are you?
Hey, good. How are you?
Good. I'm just getting everything set up here so I can chat with everybody while we watch this together.
Okay. Are you gonna? I was trying to. I came here through your account on a Trading View. I thought you were gonna be streaming over there.
I am.
Okay.
I just started it right now.
Oh,
I'm getting it.
for some reason, it disappeared for a little bit. So I thought
Um, if you, I'll post it again. Let's see, in the just chatting here on the Discord.
I see it now, though. Trading View.
Yep. Usually, TradingView actually has better streaming than YouTube.
Got it.
I got to get my
Good.
lines made up. How you doing?
Good. There's been a lot of spikes this morning.
Uh
A
huh.
little confused. But I did have a question for you.
Sure.
Um, So I was looking at Snowflake this morning,
Okay.
and on the 5 minute chart there was a bearish spike, and on a 15-minute chart there was bullish spike. I thought that was
Mhm.
interesting.
Okay, so there's a
Uh,
well, so honestly, in my um okay, so a couple things. Number one, I operate under the thesis that the higher time frame always rules. And so the 15-minute is higher than the 5 minute. So if I was going to look at this chart like I got up on the screen right here, um, I would look at this 15-minute one and I would say, okay, this one is a more valid spike. And the reason is because if you look right here, let me clean this up a little bit. You see how you're kind of getting some lows in here. And I'm sure if we went
mhm.
back, we also had this low. So you're kind of starting to see this one be a little bit more of a potential, but I actually don't like this one, and here's why. I can already see from these horizontal lines I have right here, this gray line and these dots. This is my other, free indicator I give everybody, which is retracement levels. All it is basically just a 50% retracement of whatever the major move is. So if I go from
Mhm.
here to here, like from this pre-earnings move back in August, that's the level. And so what I'd like to see is that spike happen down here at 176.69. I don't see it happening there. So this is not one that I would personally take for that reason. So that's number one, just and broadly. And also, I do have the 15-minute up here, but to keep my life simple and keep myself from getting confused like you are, I try to only I try to work in like increments of fractals. In other words, like 1 minute, 5 minute, 30 minute, sometimes an hour, 30 minute or hour. But I try not to use both. And I feel what happens is if you're trying to use like both a 30 minute and a 1 hour, there's really not that much difference. And so with a 5 minute and a 15 minute, there's like, it's 5 times 3 is 15. Yeah, you have a little bit of difference. But what I would rather prefer to do is look at the 5 minute and the 30 minute because then you have a bigger distance there. Does that make sense?
Okay. Yeah,
That
that
kind of
makes
lets
sense.
you go up sort of the chain of different time frames without being confused with conflicting signals so close together. Because are you still looking at my screen? I don't know if it's coming through very quickly on
I can see it on
okay.
Discord.
Yeah. So, this is the weekly, okay? And so we can see that there is a trend down here on the weekly. All right, we got that. If we go down to the daily, we can now see that, okay, we're in a little uptrend here. And then if we go down to either the 2 hour or the 4 hour, for stocks, I like to use 2 hour, we can sort of see that in here, we're starting to kind of consolidate. And so, but you see, if I go down to the 1 hour, it doesn't really tell me anything new. But from the 2 hour to the 30-minute, we can start to kind of get a little bit more granular. And then from the 30-minute down to the 5-minute, we can start to see some more patterns in here. So I would just encourage you to kind of pick stuff and be consistent with it. But I can see why you might get confused. So another thing about this bear spike on the 5-minute, this is not one that I would take, because one of the things that I look for with a spike is for it to be at a level. All right, look on this 5-minute right here, where let's just look at this one in isolation. So not that one, but let's look at this one right here. Okay. So these spikes, these bearish spikes here are happening as price is going up. They're not really signaling a reversal to me, because you don't have a prior top like you would right here. Like what I'd like to see is, this top form here, and then this spike is really too small. It's just really tiny. You can see it, but it's also like an ATR clearance of 68. And what that means is basically just measures how big the spike is. I want a big spike. I want a big spike that maybe like shot all the way up here and then close back down. Because that would tell me, okay, people are getting stopped out of this, basically. But we don't have that, so that's not really valid. So if we go forward a little bit, I saw one here where you have this dip, and where was it? Yeah, so now you have this level right here that formed. You have this big tank right here, and it sets up from the top to the bottom right here of 50% level. And then you have some digga. And then what happens here is you have this spike, and now this is happening at this level right here. And so if you were to say, okay, well, you know what? I want to take a long position on this level. The spike has told me where it is. That's the kind of trade I want to take. That is more valid, because, ultimately you're going to see a lot of these spikes. And the trick is, of course, figuring out what's noise and what's real. And the way I do that is I just say, is it at a level? And so if you jump ahead to this 5-minute one right here, this is a bearish spike. Let's just look at it in isolation. And so if we look at it, it's not really at the bottom of this little trend right here. See, it missed it. Like if this bearish spike had happened right here, I would have been like, okay, yeah, let's take a trade down to there. But it really just happened here. And so this is just noise. It's just opening noise here this morning, basically on 5-minute. So I wouldn't have looked at that. So the only one, like, let's see if this is, let me show you an example of one from this week. This is it going to show up here? No, it's not showing up on TradingView. Sometimes TradingView and Thinkorswim are different. What about BMY? This is the other one that I'm in. So yeah, BMY, notice how this one right here, this is a long spike from the 30th of August. You had it where price, are you still following? Am I going too fast?
Yeah. No, you're good.
Okay. So, price comes down. This is Bristol-Myers Squibb. Boom. And then you have a low that forms right here in the afternoon of the 29th of August. And then the opening creates a little spike here, and then there. So I have like this first little low right here to say, okay, maybe this is stopping out, or maybe this downtrend is stopping. But there's one key thing here that's making this thing work. And that is the fact that it is happening at the 50% retracement of the November low to the June high. Good stuff. Good stuff. This is really good. So the way I filter out good from bad spikes is I look for them to be at a level. Does that make sense?
It does.
Okay.
Thank you.
Yes. All right. Speaking of levels, let me draw mine up real quick before we got a few minutes here. All right. Let me get in case I want to take a trade. Yeah, Marcus is kind of hanging out. What I'm doing right now to that end is I'm basically like drawing up levels for the NASDAQ and the S&P. And it's pretty easy to see, this range that it's caught in since yesterday. I'm trying to make sure that, it's choppy. We'll see. I'm just going to have to watch and see what the market tells me. Sometimes these events don't give a good signal. We shall see. Bitcoin's already kind of going up a little bit into it. Looks pretty much the same. All right. Let me see if we can get this to work. Oh, no. Crap. I just messed up my stream. There we go.
Slowing down demand?
Absolutely. And the problem for the Fed is not just that inflation surprised on the upside in August, but when you look at the leading indicators of inflation, right? What do we need to see to have some confidence that inflation is on the right track? We need to see some softening in the labor market, which we really haven't seen. Initial jobless claims last week on non-seasonally adjusted basis hit the lowest level since 1969, right? So then you look at the leading indicators of employment, job openings. They haven't even begun to roll over. They actually ticked up in July as soon as energy prices came down. And then you look at the leading indicator of labor demand and job openings, which to me is profit margins, and they have not even begun to roll over. So there's really nothing to point to at this point that suggests that inflation is on the right track. So that's why I think that risks are still skewed to the upside for rates. And until we see evidence that margins are starting to compress, that job openings are coming down, it's really going to be hard for the Fed to pause.
I just wonder how much the statement's going to change. Everybody goes through the old statement, the new statement. You cross out the old words, add the new words. What's key to the language from the Fed?
So the last statement started with a pretty downbeat sentence, which said employment and production have softened. I think they have to upgrade that because the fact is that since the last statement, things have actually gotten better. Growth momentum has picked up. Even sentiment has picked up. And I think GDP is on track to accelerate pretty meaningfully in the third quarter. So I think they have to acknowledge that actually activity is improving, sort of moving in the wrong direction. I think the inflation language will be interesting. There's a good chance that they take out the reference to energy prices, pressuring inflation higher. And I actually think that they might acknowledge that inflation now is largely demand-driven as opposed to supply chain-driven. I think that if you look at the latest round of CPI data, we actually saw an acceleration in core goods inflation. So I think that puts in question this assumption that a lot of economists have been making that supply chain pressures are easing and inflation is going to ease. Retailers are still raising prices aggressively simply because they can, because consumer demand is too strong.
Netta Markowska, really appreciate your views. We'll let you get ready. If you see that Rich Handler guy walking around, just tell him to get to work. Thank you, Annetta.
Thanks for having me.
All right, still ahead. Diamond, Frazier, and Moynihan. Oh, my. The CEOs of the street's biggest banks starting their first day of Capitol Hill testimony. We'll have the headlines coming up. We're going to take a look at these markets, some key moving stocks, financials. They're mixed. The overall market's a little bit higher. 13 minutes away. Stick around.
Oh. Interesting. See, this is one that I would actually consider if we weren't a few minutes away. A little spike up here at this high. That's the kind of stuff you want to see. What's up, TradingView folks? Oh, got chat over here right now. Let me go back and read. Shorting the Aussie dollar. Do we still think that DXY is going higher? It's a good question. Dollar does look like it's going lower. No, excuse me, higher. That's a daily. The daily is still making higher highs. Today was a higher high because I think the market's pricing in a rate increase, which means dollar go up. Do you think you have a chance to go full 1 point? So the consensus is 0.75. I guess that is a good question.
Has had the joy of monitoring that hearing and joins us now with the latest. I mean, just, you're waiting. Bated breath.
What's up, Stone Polly?
The candy that you got me to keep
Google.
energy levels high.
What's Google doing?
How many are left?
It's work. There are not many left, but I did share with my producer.
Yeah, Google has been on my radar. It has been approaching, that 50% level. In fact, did it peg it today? Yeah. Google is definitely, or yesterday Google hit the 101.26. So it is the full COVID low to all-time high, 50%. Let me make a note of that. We got 8 minutes.
The changes that we've seen in the mortgage business are the most significant changes we've seen in the shortest amount of time, given the move in rates. And so we, like all other mortgage companies, have had to take a look at our own infrastructure and ensure that it's sized properly.
And JP Morgan CEO Jamie Dimon gave his updated take on the state of the U.S. economy, saying we're, quote, paying the price of too much monetary stimulus.
I think the sooner that the Federal Reserve gets the hand around inflation, so we avoid stagflation, that is the worst outcome, is inflation with no growth and unemployment, and that hurts the most people and the most businesses, et cetera. And second is to make sure we have a secure energy policy so that oil prices don't skyrocket. Energy is precarious. We know if we see it at 150, it'll cause a global recession.
In his prepared testimony, Dimon said, quote, the continued upward trajectory of regulatory capital requirements on America's already fortified largest banks is itself becoming a significant economic risk because underrepresented capital requirements erode banks' ability to meet customer needs. Brian.
I mean, the comments 150 on oil, global recession. He doesn't mince words, Dimon.
No, he did earlier speak to kind of the chance of a soft landing. He said there is a small chance that we do have a soft landing, while also noting there's a chance that we have some sort of mild recession and a chance we have a more severe recession. He didn't put numbers on those probability weightings, but it does appear that at least kind of relative speaking, he puts the smaller probability on that soft landing at this point in time.
Leslie Picker, thank you. Save a couple of those Sour Patch Kids for me.
You better hurry.
You better hurry. Good grief. Leslie, thank you. All right. Folks, that does it for us here on The Exchange. Power Lunch and CNBC picking up the coverage, the big Fed rate call, rate decision, and outlook. Next.
Peach. I'm from Georgia, so I need to eat a peach every day while they're in season. I just opened up a can of Liquid Death. Hello?
This is Georgia Power calling with an important account update.
All right, welcome everybody to Power Lunch. I'm Tyler Matheson along with Seema Modi. We are just minutes away from the release of the Fed decision on interest rates. The central bank expected now to deliver its third straight 0.75 of a percentage point hike to fight inflation.
We are watching the markets very closely. Stocks ahead of the decision are losing steam. The Dow is currently up about 152 points. S&P 500 rising 25. Nasdaq Composite is still holding on to a gain of 0.7%. The bond market clearly in focus. The yield on the 10-year Treasury note touching 4%.
We got about 4 minutes until the news comes out. Meantime, let's welcome David Kelly, Chief Global Strategist at JP Morgan
Hey,
Asset
what's up,
Management,
Dr.
Katie
Chelsea?
Nixon, Chief Investment Officer at
Just
Northern
waiting on
Trust
the
Wealth
announcement,
Management,
trying
and Jim
to
Karen, Global
do
Fixed
something real
Income
quick.
Portfolio Manager at Morgan Stanley Investment Management. Got a lot of brain power here. David Kelly, I remember when we began this cycle, I forget whether it was April or May or whenever, you said something that is stuck in my head, that the typical problem with Fed policy is that they, under these circumstances, is they start too late, they go too high, and they stay there too long. Is that still your fear?
Yeah, absolutely. The Fed, I think, will raise rates 75 basis points today. But the problem is, I think in his comments, Chairman Powell is going to still sound very hawkish and really pave the way for another 75 basis point hike in November. And this path is too much. This economy is slowing down to a crawl. Inflation is going to roll over anyway, maybe not as fast as the Fed would like. But I think the Fed is in grave danger of tipping this economy into recession by being more hawkish than they need to be right now.
Jim Karen, what do you say? You agree?
Hawkish and probably signal another 75 basis point move again at the next meeting.
Katie, the rapid rise in the 2-year note now above 4%. What does that tell you about how investors are positioned ahead of the decision?
Seema, investors are expecting 75 basis points, and I think investors are expecting the kind of scenario that's been outlined by the prior two guests. The Fed's going to hike further than we had thought and going to stay there for a little bit longer than we thought as well. So I think investors are positioning for that. But what you see in the yield curve is interesting, which is investors are also coming around to the fact that this is going to slow down the economy. So you've got this inversion, you've got this problem in the yield curve that's reflecting a lot of uncertainty about the economic outlook. So we're going to have to deal with that next year.
Jim, I'm going to come back to you because David is worried that the Fed may go too far and stay there too long and really damage the economy. You seem to have a more nuanced view of that. I've got 45 seconds. Explain why you are less worried about the economy seemingly than David is. Quickly.
Well,
Okay,
I think that we're likely to have a mild
Spike up and down. So what is it? Yeah, that's very common, that last minute. Yep, exactly what the market priced in. 0.75. That was my mistake. I was listening to them talking and forgot that thing was delayed. And we'll get to listen to Jay Powell and see what the market does then. This is a good little thing right there. It's interesting. Bitcoin got down to the bottom of that range right there I had marked off. Bouncing right off of it. Pull back to 50% there on Bitcoin. I like how you have that spike up in the last minute. It was really good, and I missed it here on the NASDAQ. Was this little spike up to go down, but Bitcoin pulled back to a little 50% right here. So if we keep going down, might come down and retest that low. See if we can break that pivot there. Yeah, 155 as things are. I mean, this is the. Did you buy puts on? Would you buy puts on SPY or QQQ? So yeah, in the like, so typical. This is literally the most common occurrence of a news event like this, where price inches up right into an announcement. Like this spike right here is just so common, and then boom, down it goes, tricks everybody in, and then goes the other way. It's so regular, you can absolutely trade on it. Let's see. We got a statement. I bet that they must have like some kind of algorithms that read this immediately and then react to it, because there's some keywords in here. I think I saw briefly like something about Ukraine. Recent indicators point to modest growth. Job gains have been robust, but the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances to the pandemic. Russia's war against Ukraine is causing tremendous human and economic hardship. The world and related events are going. The committee is highly attentive to inflation risk. The committee seeks to achieve a maximum employment and inflation rate at the 2% of the long run. What about your third mandate to keep the stock market up, Fed? We know that that's what you care about. The committee decided to raise the target rate for the Federal Reserve to 3 to 3.25%, and anticipates that ongoing increases in the target range will be appropriate. There you go. In addition, the committee will continue reducing its holdings of Treasury securities, tapering the balance sheet. Strongly committed to returning inflation to 2%. Continue to monitor, blah, 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 blah. Cool. Exactly what the market thought. So let's see what happens after. I mean, Jerome Powell is just going to bloviate for a little bit. I don't really see much happening from that. But yeah, this is the initial reaction. It's basically what the market was expecting. Exactly what the market was expecting. So honestly, by the end of the day here, if I was going to be speculative, I would actually say that, I mean, we basically just came down to the low from yesterday, which was essentially, I mean, here's basically what happened. We had that inflation print last Tuesday. That was at 8:30, Tuesday of last week, September 13th. And that tanked the market because the market was pricing in this interest rate increase. And so this whole trend down was the market pricing that in. And so now that we're here, we're basically in the range that the market has priced in. Now, if they had not raised rates, they were going to raise rates, but if they raised it less than the consensus, you would have seen it pop up. Likewise, more than consensus, but it would have broken this low. But I think the reason that you're seeing it hold this low right here is because the market is basically just what the market expected. There's no surprise. Surprise is not going to break the low with any amount of probability. And so we're probably just going to hang out right here, get a little bit of volatility while Jerome Powell is speaking. Same thing going on with the S&P 500. It basically came down to the low from yesterday. Again, what the market already priced in from the inflation print. Really breaking this low from yesterday, which is the low of this range from the last week. Yeah, from last week too. That's what it's fighting. I just don't think. The question now at 2:13 is Jerome Powell going to say something that's going to push it below this low? The job of the Fed chairman is basically to speak without saying anything meaningful. The fact that this news event just slammed it down to this low, yeah. It could break it. It could. But you know what? I'm going to make an executive decision here. ES is getting to its low. The Bitcoin trade is, yeah. right. Cool. See what happens to it. We'll just take that and call it getting paid for our time. Yeah. Should you buy? I think it basically just brought it back down to the bottom. I don't see any more news coming out that's going to punch it lower. I mean, that's what you were kind of waiting on to see if it would do something the market didn't expect. The market got it right. When the market gets it right, there's really not much edge to be had. It's basically already priced in. Right now, I'm just going to logging the experiences. Inverted cup and handle on which instrument? Kind of cool though that yeah, again, like this was really kind of the spike. If we play it out, I got a little distracted, but I caught the Bitcoin thing. Yeah, I was listening out the corner of my ear while I was doing something else. But the key was basically is VM here still? No, he must have left. He was asking me about spikes earlier. So this was the spike here at 13:39, 1:39 p.m. You know, price shoots up, closes back inside the red line, the 9-period median. So you can set up a trade on the next one, stop right here because you know if it breaks that high, it's going higher. You know where your stop needs to be. And your conservative 3-to-1 is there. But of course, that low is all the way down there. So there was a good opportunity to catch a 7-to-1 on that move. Now we just kind of hang out. watch the charts, not CNBC. I think I've actually made a video on that before. I think we caught that pretty good on the Bitcoin. $5 say we close green on the day. No, I'm not gonna take that bet. I think we close a little red. Were we green before the move? What's break even on the day? How did the day open today? It depends on, let's see. SPY. SPY opened the day at 386.11. Wait, no, hold on. SPY opened 386.11. Yeah, 386.11. I think we close a little down. I don't think we really get up to the high today. Possibly tomorrow. Depends. Jay Powell's going to talk here in a second. We'll see if he says something dumb. Doesn't it continue to be interesting though? The stock market cryptocurrency correlation. They look virtually identical. Out here on the 1 minute. Leg down and then just kind of now creeping back up. Just another risk asset. Coming down from the handle now. Okay, so explain to me the inverted cup and handle. Is this the cup? And the handle? I'm just not very, the chart patterns that I go for are pretty simple, like double tops. Sometimes head and shoulders. Perhaps I would be well served, but really, like in this, as far as my trading goes, I try to keep things pretty simple like that. Really just that spike up. That's the key for me. A bunch of people getting stopped out. And then really closing out here on the Bitcoin had to do with, basically we came and touched the bottom here and I started just processing in my head, okay, we're probably not going to break that here in the next couple minutes. I wonder if we'll get some volatility when Jay Powell starts speaking. You start speaking about 2:30. Green again, what? Semis have bottomed. What are the semis? Semiconductors? See, when you say SMH, I think, oh, yeah, okay. When you say SMH, I think in Zoomer terms, shaking my head. Like shaking my head green again. Are you really invested in semiconductors? This looks like a chart of NVIDIA. Yeah. Yeah. As sort of, I don't know how much this affects it or not, but the fact that Ethereum went from proof of work to proof of stake is really kind of not good for NVIDIA. A lot of video cards were being bought last year in the rise of crypto. Couldn't even get a nice video card. Now you can. So if you're a gamer, this is good for you. But if you're a investor in NVIDIA or a crypto miner, it is not. Sitting on cash since November. You wanna let me borrow that crystal ball? Well, I was able to, hedge, essentially go short completely, go net short cryptocurrency, at least the ones I care about. I don't have any of the meme coins. But I thought the stock market was going to hold up a little bit better than it did around March. And I started buying in around March, and whoops. So I've had to I've had a very, very annoying summer. But yeah. Okay. Well, sometimes I get it right. I kind of thought myself into a take profit on the Bitcoin trades. That was good. I can be proud of myself there. I'm kicking myself a little bit for being distracted there on that NASDAQ one. But always another FOMC. Well, that's a nice hedge. Sure, volatility was up when you did that too. Here comes the 30 minutes. All right, let's see if we can turn on while I go through that list of spikes. That's a lot of things to look at.
Or is a lot of that already in the soup?
I think a fair bit of it is done, at least for the median stock out there. For a lot of sectors that have actually adjusted, we've had a valuation reset. It's all about whether the economy can actually stay. Look, nominal GDP growth they're projecting is about 4% for the next few years. That's not awful. And so we'll see how corporate earnings can fare in an environment if that's something like what we get out there. I think you're still talking about the Fed doesn't want the markets to get too comfortable. And right now it's succeeding.
Yeah, it is definitely succeeding in not letting the markets get too comfortable. Mike, thank you very much. I want to ask you to stick around for just a second as we watch the clock here counting down to 2:30. He's usually pretty close to time. Take a note of where the Dow Industrials stand right now, down 188 points, just for reference's sake, as you watch sort of the EKG of the market.
So I like Litecoin
over the next 45 minutes.
Hey,
I
see, I thought you saw you in chat here, Vint. Litecoin on the 30-minute made a nice little spike here. Listen to JPal talk while I go through some stuff.
Good afternoon.
Yeah, that stays up. That's good.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
Man, I really actually like
the tools
his voice.
we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We're moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth
GLD
elevated.
made an interesting spike here.
Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored.
Up we go.
As reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely
email me the
loosening
crystal
policy.
ball.
As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be.
I seem to recall a time when he spoke before.
We are taking forceful
the market
and rapid
did
steps
arise,
to moderate demand so
and
that
then
it
as soon
comes
as he
into better
stopped
alignment
talking,
with supply.
it went down again.
Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well. Is likely to require a sustained period of below-trend growth.
With a pause.
And there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
What's the VIX doing?
We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country.
VIX spiked up.
Everything
on this,
we do is in service to our public mission. We at the Fed will do everything we can
VIX
to
is kind of
achieve our
holding
maximum employment
this
and
range
price
right
stability
here.
goals. Thank you, and I look forward to your
27,
questions.
or basically 28. Yeah, if that's
Hi, Chair
all it
Powell.
is,
Thank you
this
for
is
taking our
kind of
questions. Gina Smilik from the New York.
Oops, didn't mean to do that.
Give us a little detail. Know when to slow
I've
down
kinda
these rate
used-
increases.
I've used the VIX to try to time the market. It's been pretty good in history. And having a little spike out here on the VIX is very indicative of a market bottom, actually. Like, it's amazing to me that we had even this dip from the inflation report last week. Yeah, everything depends on the algo interpretation. Yeah. Wait, what do you mean by that algo? You mean like how the algos interpret the news when it comes out, or something else? Could be the bottom.
And in light of the high inflation we're seeing, we think we'll need to.
The bottom is when no one's
said,
buying.
We think
by
that
the way,
we'll need to bring.
That's literally the bottom.
Our
Don't
funds
forget
rate
that.
To
so
a
if
restrictive
everyone
level
thinks
and
it's
to
the
keep it
bottom,
there for some
it's
time.
not the bottom.
So what will we be looking
It's the
at, I guess, is your
enigma
question.
of markets.
So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the
I'm gonna
labor
step away
market
real
showing
quick.
a return to a better balance
I'll be right
between
back.
supply and demand.
Restroom break.
And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear? Do we keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today,
who said we might close green?
We've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So You're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, it is
looks like you're gonna be right. Is that crystal ball?
What we generally expect, because we see the current situation as
What's your thought process on that?
Experience in a number of ways. And I'll mention
Why
a
do you
couple
think
of
we're going
those.
to close green?
First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings are down significantly and they increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine,
okay.
have all contributed to the sharp increase.
Kathy told you, huh?
So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better,
you could probably upload on my Discord. I'm not sure if you're on there or not.
It's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether
coming on up 140.
Also, do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding what the labor market is.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talked about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points. Addition
from a technical standpoint, that 140
so that would be 25 basis points less.
Seems to be a nice little
we're gonna make
inflection
that
point
decision
there.
at the meeting. We didn't make that decision
basically
today.
the month of September.
I would say that
like
we're
on a
committed
technical
to
level,
getting
just,
to a
gaps.
restrictive level.
The gap there from
for
the
the
8th
federal
to the
funds
9th,
rate,
yeah.
and getting there pretty quickly. And
Pretty
that's what
significant
we're
level
thinking
there.
about.
Just as a follow-up to that, I'm wondering about the sort of risk management considerations here, given there's some discussion now of overdoing it. What's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a 10th higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched, perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy. and staying there until we feel confident that inflation is coming down. That's how we think about it.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment, price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy, and otherwise, the economic developments that are taking
Switzerland's
place
just a nice place to visit. I'd go
that is
try
very
to go
much
hiking.
baked into
I've been there once.
our own forecast.
Very beautiful country, very clean.
Of the U.S. economy as best
Alps
we can.
are
It won't be
really
perfect.
beautiful.
So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong
Okay,
corporate
that's good
profits.
information.
And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates
I'm going to
moved
case the
up,
itis
so we
this
should have
afternoon.
had a lot of tightening taking
Jay
effect.
Powell's put me to sleep.
Why is the economy,
All right. That being the case, I got some chores to run. So thanks for hanging out, Chelsea. Send me
You're
your
right,
crystal
of course.
ball
The
if you
labor
would.
market in
Good
particular
trades
has
there.
been very strong.
To follow up, we got a little distracted, didn't catch the NASDAQ, but caught a little bit out of Bitcoin here. So good afternoon, good worth time to watch. Shameless plug. Join the Discord, it's free. Thanks for following me on TradingView. Love you guys. And I'm out. See you Friday for the regular live stream.